My name is Addy. I have over 10 years of experience trading options. I started like everyone else, buying options and losing money. Every few weeks, I would see my account wipe out and things would not work. They might work for 1 out of 10 trades, 2 out of 10 trades, and then it would not work. So things changed, and then I started selling options, and then things started to like make more sense because it was all about probability and mechanical trading, if I can say, not hype and emotional trading. Emotions were just kept out of the trading cycle because I would just, and still to this day, we just trade based on math and probability and volatility and all that kind of stuff. So today's webinar is about showing you what we have done, how we can help anybody who is struggling with this same kind of problems, same pain points, cannot figure out what strategy to trade. Even if you get into a strategy, how to defend a trade, how to complete a trade, and how to basically take it to completion and get out on the other side as a winner. I want to give a heads up right now that at the end of this, there is a 5-day challenge paid program that I will show you exactly what it's all about. If you think that there is value here, you may want to look at that 5-day paid challenge, which we run once a month for 5 days, 1 hour a day. And I've covered 5 different strategies there in detail and in depth live on our broker platform. Now, today's trading will also be live. I will show you an example of a trade and just show you how we actually do things. Let's just get started on everything that we do. How do we do it? And what do we actually do here? Let's go to the slideshow. And again, like I said, in the middle of this, when there is a live strategy section, I will take you to my platform, which is already signed in. I'm here. This is my live broker platform. You can say it's real-time data. When it says real-time green, that means it's a live account. It's not a paper trading account. We don't use paper trading anymore. I used to for bigger positions, but we just don't do that anymore. Okay. We are here to build consistent monthly income with options. That's the goal. If I were to put it in one line, this is what I would say, that I want to build consistent monthly income without guessing any direction, because directional markets are really hard to guess, to time, and to everything. Okay, so what have I put here? 61% win rate versus 100% win rate. What is this? We did a research on Apple covered calls recently, like with live data from options data provider. We looked at all the exit strategies, all the entry strategies. And with only one filter, which was the IV filter, which we use in our daily trading, we could see that the win rate went from 61% to 100%. And the net P&L went from negative 4,500 to plus 500, $5,000 difference between the two. I'm going to show you that filter right now through this webinar. What you will leave with tonight, the market is boring 80% of the time. Why do I say that? I will prove it with the numbers as well. What I mean by that is 80% of the time, the market stays within a range. And we can calculate that range. The range is already calculated. I will show you the workings on that. And now that we know that the market stays within a range, we can sell options outside of that range so that it doesn't breach our short strikes on either end. So we know what range that is mathematically. And we have proven that by comparing it with actual data versus predicted data. The normal distribution predicts that the market stays within a range, one standard deviation range, 68% of the time. And we have seen that the market stays within its range of one standard deviation 80% of the time in the last 25 years. This is based on last 25 years data of SPY returns. The execution system, we sell at 17 delta. We sell 45 days out. And we exit at 50% max profit. Again, everything I will show you will make sense a little bit more. What we do is we also survive the remaining 20%. So the 80% of the time we have a winning chance. I'm not saying we win 80% of the time. We do have a high win rate around 70%, maybe 73. We could increase that win rate to 80%. But the remaining 20% is where we need to survive and make sure we don't lose a lot of money in that 20% that it wipes out our first 80% of the gains. So how do we do that? We position size, we roll, and we play with the casino mindset, meaning we sell options with probability. And for that reason, we play the math and the numbers. We don't play emotions. We don't play hype. We play price action. Yes, whatever price action is in the market. I don't have a fundamental view on where Apple will land in the next 5 years. I just don't know because we don't do that kind of analysis. Maybe in the future we will. Overall, based on price action, we know where the market will go. You're not losing because of your strategy. You're probably losing because of how you execute. That was my problem, and I'm trying to portray it through this webinar to everyone. This was my problem. My problem was not strategy. My problem was the mechanics of it, the being disciplined and being methodical with it. Meaning, what would I do or what should I do if the trade goes wrong? Because not every trade goes right away. A lot of the trades go wrong. And when I say wrong, sorry, 1 second. When I say wrong, I mean on the losing side. So what do? We adjust, we roll, we look at IV, we look at wherever our PNL is, and then we make a decision. Again, this was me back in the day. If you are resonating with all of this, then we were in the same boat. The way I got out of it and got onto the other side is by researching, learning, by losing money, by investing money in the market. I've been doing this with live money for the last 7 years. So I have got the experience to tell you this is what I think about IV and this is what we should sell and not sell. Again, like I said, it wasn't lack of knowledge. It wasn't lack of strategies. It was just lack of structure and decision system. And that's what I've created here. When I tell you that I have a better product to help you, the 5-day covers the whole thing. I will show you later. The buying option is a losing proposition for us. We don't do that anymore. I was tired of guessing direction and timing. It was just the worst thing. Nobody can do it. I think it's a very low probability trade, whereas selling is a very high probability trade, given that we manage the trades properly. Selling can blow up your accounts as well, but not as much as you can do with this thing. Buying options, you will win small, but then you will lose quite often. Okay. Selling, you will win small, but you can always limit your losses by mechanically adjusting the trades, rolling the trades, and doing all that kind of stuff. I did 25 years of data, which was 6,300 trading days, back tested it, and then I built something that we can take a look as well. What is a probability edge in this? Let's start look into what the probability means actually. The only way to get consistent income from options is through a decision system, and that's what I follow now. I wasn't following this before. I was just doing strategies here and there, watching videos, watching indicators. I don't even look at technical indicators anymore, only apart from one or two, which I will show you on my platform, which is just set up. They're all in my YouTube videos. We create a lot of YouTube content as well, educational stuff, courses and everything. All the free stuff is out there. You will see what the difference is when you start selling options versus when you are buying options, okay? And by the end of this presentation, I will show you exactly how we do it. The first rule of that is we have 3 non-negotiable rules, which is we sell high IV underlyings, we sell only liquid underlyings, which means we don't sell meme stocks. We don't sell very, very cheap stocks. So our universe is basically top 40 names. In the futures options market, I have a universe of probably, I don't know, maybe 10 underlying tickers. And it's enough for me to generate consistent income. And I can show you that because futures options can give you good exposure to commodities, to equities, to interest rates, to currencies, you name it, it is there. If you never dealt with futures options, I will show you exactly what I mean on the platform as well. And then we trade small, but we trade often to keep portfolio risk down. The textbook says that we have 68% chance of winning each. The underlying stays within one standard deviation 68% of the time. But I can prove that this is not the right number. The number is actually higher than this with some math behind it. So here's the real data. I ran 25 years of data on SPY. 80% of the time, it stayed within its one standard deviation move. This is the backing of it. Okay. First thing first, download the prices in the last 25 years from Yahoo Finance. They're all free. You can just go and download it. Whoever joined today, I will send the whole file to it. Then this is the summary. Okay. SPY data from this and that, daily closing prices. Annualized volatility on this was about 19%. This is totally fine too. It is in line with what VIX has been in the last 25 years. If you look at VIX chart and draw an average line on it, VIX is basically a volatility number on S&P 500. Okay, so the next thing we looked at was median daily return. That's fine. The daily standard deviation, that's what the daily standard deviation is. There were total 6,300 trading days in this data set. When we counted the one standard deviation move, which is coming from the daily data count, you can see that the actual number was around 80%. The textbook number is actually 68%. If you cannot see that, I will increase the size of this. So what this means is that market clusters tighter than predicted. So it stays within that range more than what the textbook says. Okay. What can we do about that? We can sell options around that range, outside of this range. And I'll show you exactly what I mean by that on the platform. How can we do that on the outside of this range? When you calculate 2 standard deviations, it is exactly like textbook says. It's pretty much in line. This number is slightly distorted, but the other numbers are very much in line because the further out you go, more accuracy you get in this normal distribution. And that is why these numbers are more closer to textbook than this one is. This is where the seller's edge is. And also the analysis will tell you exactly what the 1 standard deviation, 2 and 3 are. The whole methodology and the formulas are here, but I want to show you the distribution. So this is the main thing. The distribution stays between, I would say maybe minus 1.3% to plus 1.7% on the daily basis. Or you can say minus 1.3 to 1.2. That's your daily range of daily SPY returns. And if you look at the distribution here, that's exactly what this is, from between minus 1.5% to plus 1.5 if you want to cover a bigger range. So you know that on a daily basis, SPY returns are basically minus 1.5 to plus 1.5. In terms of standard deviation, what does that mean? That it is one standard deviation of its mean. Okay. This data actually tells us that it stays within one standard deviation of its mean almost 80% of the time. Okay. And that's what we have here. 80% of the days are boring. That's our edge. But we also need to be careful about the tail events. We don't want to let the remaining 20% take out our profits on the first 80%. So now we know the edge. What can we do about the edge? We can basically sell options and sell premium very often, or at least hasn't done in the last 25 years. Now, here's the problem. The calculation is based on 25 years and we sell in 45 days. But if you look at the 45-day numbers, it's almost very, very similar. So if you look at the 45-day numbers, because we sell at 30 to 45 days, 50 days, within that time period, given whatever the market regime is, the bullishness, the bearishness, and whatnot, high volatility, that's what the edge is in our favor. And that's what we try to execute. Now, this is the execution part. So this is knowing what to sell, when to sell, and when to exit, and what to do when it goes wrong. So there are 4 parts to it. What to sell, when to enter, when to exit, and then what to do when it goes wrong. That's all you need to know to become a good trader. Because entry is what you control. The rest of it is what market controls, right? And if you know how to adjust the trades and how to actually be mechanical about it, you can actually do well by being very patient and just not reacting to the market all the time. Because we don't react to the market. We have rules in place. The first rule is the 2 times premium rule, and it will come up here. So this is a 1745 rule, meaning we sell at 17 delta, sometimes around 18, 19, 20 as well is fine. And we sell most of our positions. I would say 80% of our positions are around 45 days, but we also sell around 35, 40. We don't sell less. I don't sell less than 30. That just doesn't work for me. It's too much volatility. There's a lot of movement around and I don't like that, the volatility of my P&L, and I don't like that. And I exit 80% of the time at 50% if the trade goes well. If it doesn't go well, then there's some rolling rules, which we will come across next. But here's the account size that I follow. And if anyone is looking at this and they want to know how much money to spend on these positions, this is the account size that we follow. These are the allocation numbers that we follow, okay? If it's a $10,000 account, each trade cannot be more than $500. And I can show you that you can create a trade for less than $500 and get the same amount of exposure as if you were selling something in Apple or a big ticker item, okay? In the futures option space, easy to understand, very good leverage amount, and easy to very, very liquid markets. The 3 good parts about the futures option space: easy to understand, good leverage, good capital efficiency, and then very liquid markets across the board. Again, this is my Apple short puts data, back testing, 3 years of data. When I did this, we only had 3 years of Apple data, so that's where the numbers are coming from. But now we have almost 10 years of data in our tool, and I will show you that tool as well. Okay, let's go through this theoretical part first. It's not my favorite thing, but I have to show and explain things before we go into the practical side of things. But this was with one filter. If we filter the IV rank to above 50, our net result becomes positive versus negative of 4,500. So implied volatility is our edge, is our seller's edge, because we sell volatility whenever it goes up. It's a mean reverting asset. I can show you a chart of wicks here, and you will see what I mean by mean reverting, meaning whenever volatility goes up here, look at these in clusters, it always comes down to its average level. And the average level, if I were to draw a line here, is about 16% in the last 1 year. This is the last 1 year data. VIX is implied volatility. SPY data that I collected is actually realized volatility. So it's already happened in the market, so it's slightly different, okay? Implied volatility is forward-looking, and VIX and SPY data that I collected is actually slightly backward-looking or historical vol, which is what already happened, okay? So there's a slight difference there. It's a mean reverting asset. It goes up, it goes down. It goes up, and it goes down. Because there's a big positive drift built into the market where 80% of the people, I think, this is not actual numbers, actual analysis, whatever, this is my guess and my experience, that 70 to 80% of the time the market goes up, okay? And therefore we avoid selling calls in SPX and all these major indices because they have big positive drift built into it. Selling puts, yes, for sure, all day long, okay? Goes up, goes down, and then comes back to its mean reverting level, okay? You can look at the IV rank as well. It's always around, about 100-ish. That's its IV rank. Slightly higher right now. This is the chart of like applied a IV rank filter. This is how the results change. And therefore we sell when IV rank is high. It's all real data telling us that only sell in high IV environments. Do not sell in low IV environments like this, because there will be negative P&L otherwise. Okay, there's a $5,000 difference in between the two. And that's exactly what we show you how to do. And that's exactly how I trade in my regular account. And I show you how to do in the 5-day challenge. This is the meat of the presentation. Good stuff. I like this bull put strategy. Let's go and check it out on the platform. Okay. First things first, what is a bull put strategy? It's a bullish strategy, bullish to neutral, where we sell a put higher than a strike, and then we sell and we buy a put lower than that strike. Okay. The net credit is our max profit. The risk is basically the spread minus the credit. And then the directional bias we know is neutral to bullish. Okay. How do we set this up? And what do we actually look for? A couple more slides here, then we go into the platform. Here's something very, very important. I look at open interest and volume. Volume is also implied volatility, open interest, delta. These are my columns. If you look at my broker setup, if I go here, I don't want to trade VIX, I want to trade ES. Also, we trade contrarian markets, meaning if the price goes down, we sell puts. And that's how I've been trading for the last 2 years. And it's been very successful, meaning S&P 500 is really extended right now. Look at the numbers here. If I were to do anything here, I would sell calls, not puts. It's at all-time highs, extended too far, too quick, okay, onto the right. If I were to do anything here, I would sell calls. But again, selling calls has hurt me in the past in the major index, not anywhere else, but in the major index. The other good setup I see right now is in the bond market. So look, bonds are down. It's not down to its lows, but it is down quite a bit. So lows were like 110 in the last 1 year. It's trading at 114. This also gives you a good exposure into the market overall, economy, and then good amount of credit versus the amount of money you put down. But because a lot of people understand S&P 500, we will stick to this one and then see if we can set something up here. Once I've gone through, how do we survive the tail? Now, this is again, tail numbers, some worst crash that I've seen in the 45-day window, about 36% down on my position on the Lehman 2008 scenario. Average crash is about 25%. So here there is risk to it. And I'm showing the overall picture. I'm not just showing the rosy picture of like how good it is. This is how bad it is too. 4.2 to 1 crash to rip, meaning 4.2x times 1 on your rip side. There were 80 crashes versus 19 reps during this period, okay? One loss can wipe out 12.5 winning trades, and that is the reality. This is what this means. 4.2 to 1 means one loss of 25% can actually wipe out 12.5 winning trades for you. It hits hard, I get it, but we have to be mechanical. We don't ever lose max loss on our positions because we adjust the positions. The adjusting rules and how do we survive? Okay, first of all, we trade define risk. We don't leave the risk open on the table because then that gives us good night's sleep. If we define the risk, I start with a credit spread. We do a couple of things really good, which is a credit spread in the futures option space. I know new iron condors, I don't like them. Very slow moving vehicles. I don't like the selling in the middle and the selling both sides. I don't like that. I sell one side and then I sell one side when the market is juicier. So selling into the strength of the market, meaning these are our non-negotiables, where we only use 2 to 5% of our account per trade max. If there are more than 30 days left and I've been tested on the trade is not going well, then we convert that into an iron condor. If it's less than 30 days, we roll it out for credit. There's enough opportunity to roll out for credit, go further out in time, and be patient in the trade. The goal isn't to win every trade, it's defend, get back to break even, and then survive to trade again. Because not every trade is going to be a winning trade for you. Okay. So what's the casino mindset? This is what it is. Run a profitable table, survive the bad nights, come back tomorrow. That's how we trade in this market. And trust me, there are a lot of opportunities. If you've never sold an option before, 7 years ago, I was in the same boat, always buying the option because it was easy to understand and easy to lose money too. Okay. This is a little bit hard and you get an edge on 70% of the other population who are actually buying the option is seeing their options expire worthless. We need to go into the platform and I need to show you how to set up. Look, it's a contrarian trading. What would that be? S&P 500 futures is really extended right now, but we will not sell calls here. I don't like selling calls in this one, especially in this product. It is very difficult to make money on the call side. And the reason I say that is this. I sent an email this morning it tells us what are the winning percentage on the call side versus the put side. And how do I know this? Because we've tested real data. Before we actually come to this email, I want to show you one more thing. When I say real data, I mean this data. We are building the skilled options platform, and this is how everything looks here. Okay, there's a dashboard. First of all, this is everything in this dashboard. Could you add me to the newsletter? Go onto this main blog page, just put your email and name there. You should be able to sign up. Okay. Implied volatility, positions, you can bring in your portfolio. You can build your portfolio here. I have built it with SPY. The reason for that is because in the back end, in my database, I have options data for 3 main tickers right now: SPY, Qs, IWM, all 3 major indices. Plus, Apple data is getting loaded right now as we speak. It's slightly slow for us because we don't have enough money to like go for full speed. So we're doing things slowly. Anyway, the SPY data I bought theoretical 100 shares at a 169 a piece. Now, this price was available on 1/1/2016 because I only have 10 years of data in my database. So remember that. And all of this data is actually coming in from a real database. Analytics. If you want to analyze your portfolio, you can do this by putting your dates in. You can use today's date, actually. It's quite up to date like that. Okay. You can see your percentage returns. Now, what this chart is doing is actually giving you a portfolio, and then it's also giving you a benchmark. So the benchmark here is Qs, which is NASDAQ, and your portfolio is basically SPY. And therefore, if I click SPY as my benchmark, it goes on top of it because my portfolio is my benchmark. So there's no active return or active risk. Okay. But if my benchmark was NASDAQ and my portfolio was SPY, there was a 200% difference between the last 10 years. Fine. NASDAQ goes up more than SPY anyway. We all know that. This is how your $10,000 would have grown in each of these. If you would just leave in there and then let it grow for 10 years, this is how much you would have collected. Now, this is the best of the tool that we've built so far. Back testing strategies. We have 2 strategies built in so far. This is our go-to number, 17 delta 45 days. Now, whatever I'm teaching, we are actually building it. It's not just fluff that I'm telling you. This is not just BS. And I don't leave you alone by just giving you a presentation and then going somewhere else, because we are actually building this tool based on whatever we teach. Okay. So it's all real stuff. Okay. What is this? This tool is actually a back tester on your portfolio. Now you can add your portfolio and you can remove your portfolio. It's up to you. You will get an overall evaluation of wherever your positions are. For now, I'm going to take it off and I'm going to show you something. There are 3 exit scenarios. Again, I showed you my preferred exit scenario, which was 50%. We have other exit scenarios. We are bringing one more in where we roll the position out. Okay. The rolling scenario is coming in soon. So this is how a covered call has done based on total PNL. This is how a covered call has done on SPY. If you just had 100 SPY shares and you sold 1 option contract on it on the call side every 45 days at 17 delta, this is what your PNL would have been in that position. Okay. I like the win rate because it's psychologically, it's better for me. I don't mind losing out on some PNL because if you do it from PNL, you made 4,200 max. If you look at the win rate, we made 3,000. So probably $1,200 less. But everything else was positive. Our efficiency was positive too. Okay. The best scenario to sell options, according to the real data of the last 10 years, is 17 delta and 30 days out. We are still selling it at 45 days. So maybe, there's something to look at. I'm not denying that there's nothing to look at. Yes, there is something to look at for us. 25 delta, 30 days out on this specific ticker has also worked well. 84% win rate, $3,300 total PNL. When I say 3,300 total PNL or 3,000 total PNL, what do I mean by that? So this is the total option PNL. Now, if you look at this line here, these numbers should all match and the chart should all match and everything, right? So this is what I mean by this strategy. If you were to sell 1 covered call on your SPY position for the last 10 years, this is what you would have made in the position. Your option PNL would have been positive. Your equity PNL, because you hold 1 stock and the stock goes up, right? Covered call means your prices has gone up. So you made some stock PNL too. Your total PNL would have been this much. Okay. This is in this scenario, 25 delta, 30 days to expiration. If you have sold 1 option every 30 days, okay, what else can you get from here is you can go and then you can just click into this, go down here and then look further into this actual row. 89% win rate, all of this based on years, which years would have been better, profitable, break even or not. The next thing you can look at is go into the details section and see exactly what options have you sold. How many days have you actually held it for? So the first option you made money on was held for 16 days. Okay. And we sell monthly options. So this data is all built out on monthly options, not 0 DTEs yet. We don't have the data for 0 DTEs yet. We are still building the database and the tool with our 45-day, 30-day mechanisms. You can take a look here. I can give you the link. You can go and join this and then just play with it. See how your portfolio is done. And then you can also download all the trades that have actually taken place. So whatever we teach, we're actually building it into our tool. Again, I can just give you the link here in the chat. Go and take a look, sign up if you like it. Okay, so I was showing you the email that I sent on the win rate. Okay, these are the scenarios we ran. According to our research, 17 delta, 45 days out. Puts worthless 89% of the time. Calls are only worthless 60% of the time. And you know why? Because the market is bullish most of the time. It has got a positive drift. So therefore, it breaches your call side. And this is why we do not sell calls in ES or S&P 500 or SPY unless we hold a stock. Okay. We don't sell naked calls or call spreads. I just don't like it. The best scenario here, again, proven by whatever we saw on the tool as well. Look at this. 17 delta, 30 days out. The puts expire 90% of the time. This is the expiration rate, by the way. And the calls expire 73% of the time. So the best scenario here is 17 delta, 30 days out. And we can test that on the cash secured put strategy here too. So we have two strategies built in right now. One is a covered call. One is the cash secured put strategy. 17 delta, 30 days out. Run the simulation, and then you will see the change in your P&L. Look how big the P&L is when you start selling the put side. I just want to show you the cash secured put strategy, the way it changes everything. Because selling into the strength of the market, selling a put has always been the best strategy. Look at the P&L here, 100% win rate, 98% win rate. It's just crazy how things are when you sell a put. If you were downloaded by total P&L, look at the P&L, $57,000 P&L in the last 10 years. These numbers are crazy. 100% win rate, 98% win rate, 17 delta, 45 days out, good as well. Look at this. 97% win rate out of 120 trades. Okay. You can just download this and then just see how everything goes. But yeah, let me just take you to the platform. Sorry, got sidetracked there. Again, setting up a bull put spread. How does that work? My favorite strategy is selling the put side. You always get good premium, you get good leverage, and a market always goes up. So put spread usually works. I just showed you on the back test as well of SPY selling puts. And by the way, one thing to notice, there is no equity P&L here because this is a cash secured put. You don't own any equity right now. Okay, we're just selling the put. So therefore, this is the only options P&L that is showing up. There is no equity P&L here. So based on that, let's look into the quick setup of the trade. If I were to trade an ES short put spread, a couple of things to notice. Open interest and volume. Look at this in thousands. Volume is market is closed, so it's NA right now. If you look at this in the morning, yes, it will not be NA. So thousands is good. And then our setup is usually 17 delta. So it's 65.75. Sell a vertical. Okay. One is fine. Analyze the trade, and you will see that you are covering the expected move. This gray part is the expected move. Now look at this. This is the probability range that we talked about, 68% of the time. This is what the underlying is supposed to do 68% of the time, and we have a win rate of 87%, okay? Look at the deltas here and the other Greeks. Very small open delta, positive because we're selling puts, negative vega because we're short volatility, and positive theta. This is how much we will collect every single day if we were to trade this, okay? Short puts on the put side, short put spreads are always good P&Ls. And my last thing, what is a 5-day challenge? We go deep into 5 different strategies. I think it's better if I show you the website. This is where it is. Let me send you the link. So if you are interested, and here's the thing. If you sign up right in this class, you will get a 10% off. This is the code. It will expire in 1 hour after the class. So if you need a 10% off, and use that code to buy the ticket. So this is what we will cover. On day 1, we will go through the foundation of why most people lose and all that, right? I will show you exactly how we structure the trades and how we make decisions. On day 2, we go right into the strategy. So I show you bull put spreads and I show you bear call spreads. The 2 strategies are covered here. The whole setup, the whole risk management of it, the whole exit rules, and the entry rules, okay? And we set up a live trade. On day 3, this is the best part. I show you the differences between strangles and straddles, safer and higher premiums, volatility trades, expected ranges, and again, how to manage these positions too. Day 4, we go into zero DTEs. So we go into zero DTE iron condos. I'll show you my setups, how I've been trading these and how I've been successful with this. The full focus is on zero DTEs, how I trade it. I don't trade anything other than index options on zero DTEs. When I say index options, I mean SPX options, not even anything else. So SPX options are the only ones that we trade because they are cash settled. They're not delivered. They are not physically settled at all. they're all cash settle. So we trade that one for 0 DTEs. On day 5, I go through iron butterflies and iron condors, the proper iron condors, not the 0 DTEs. This is on day 5. We go through live trading. I show you the exact setups, the exact Greeks, which buttons to click, which strategy to select, and how to actually manage it. Now, you don't just get 5 days of learning. What you get is 4 months of support. So with all this, you get private community. I will give you the scorecard template, and I will give you the complete decision framework so that you don't look into the screen completely lost what am I supposed to do right now. And the community support. If you have any questions on your positions, we have a Discord community. We call it the long shot idea. I have a couple of members. I'm not very active, but yes, I'm only active for my paid subscribers there, mostly in a separate channel. So we have that going too. My only takeaway, if I were you, even if you don't buy the ticket, that's totally fine. You must have learned something today. And if you did, that's pretty awesome. Just don't go out there and buy up. Watch some videos on our YouTube channel. And that's pretty much it for me today. See, here's the thing. For a short put strategy, you need a lot of money, okay? If you were just selling short puts into, let's say, Microsoft, right? You need a lot of money to sell one single contract of this underlying ticker. For example, let's say if you were to pick this 58 days out and you were selling a 19 delta short put single, look at the amount of money you need. You need $3,900 to do this, to collect $675. Now, short puts and short calls is a strategy only when you want to buy something that you want to hold for too long. That's when you sell short puts. And short calls is when you've acquired something, you've been assigned something, and you want to sell some income on it. You want to generate some income on it. That's when you sell the short calls. That's the difference between the two. Thank you for spending the time with me, and then I hope you found it useful. If anyone has any more questions, just let me know. Otherwise, we can wrap it up right now, and I can send the replay in the email tonight. And I am hoping to see you all in our 5-day challenge, which starts next Monday. It runs through the week. We do 1 hour a day, each day for 5 days. That's the challenge. Then what happens? So I don't leave you there. Then you join the community, and then you try to do this thing by yourself. It doesn't make sense. You ask me questions on the community. I do my best to help you. If you have any bad positions, I can help you with that as well. I can take a look at your account, your portfolio, and then see how can you improve your position. I don't have level 2, so I should probably wait to take the class. No, you can. We don't, the stuff that we do doesn't require level 2. It doesn't require level 2. I believe it doesn't. Don't quote me on that. I can confirm that to you. How many trades do you do on average in a week? Okay, so we don't trade too much. Here's another thing. We only trade when the price action allows. So I traded oil when it went up. I traded ES when it went down. Only when there's extreme price action, that's when we trade. If I were to tell you the exact number of trades, maybe 1 to 3 trades a week. Trading not too often has worked well for us because we only trade extreme price actions. And it just comes naturally to me. So I showed you ES example, right? It was extremely on the top. My instinct is like, I need to sell calls here. But because I've been burned so much on the call side, and my research is also proving this out, that the call side is not very profitable in the long run, I don't sell calls. Whenever indices go up, I don't sell calls. Okay, when commodities go up, yes, I sell calls. When the equities go up, I don't sell calls. It just doesn't work for me, so I don't do it. Sell puts all day long. When the market goes down, we sell puts all day long. And then we manage the trade. So that's the giveaway there. What else? I think that's it for me. No more questions. I am hoping to see you guys hopefully next week. If you have any questions, just email me. I've been selling cover calls and have done well. Great. Awesome. I can pick your brains on that. Like, what kind of underlyings? Do you sell calls in major tickers or something else? NVIDIA, nice. Wow, that's a difficult trade, man. Like selling calls in NVIDIA. Apple. Okay, Apple is good. Thank you, Nitin. PLT are good, but these are all like, I'm guessing you're making most of your money on the equity side, not on the option P&L. Is that correct? Because these have been really bullish though, these tickers. Yes, I thought that. Okay, so you're making money on the P&L on the equity side. That makes sense. Because really hard to make money on the short calls in these tickers because they've been going up. They just don't go down. But again, covered call is a good strategy if your underlying goes up. In my head, I'm thinking that's the best outcome because if the underlying goes up, you beat all the benchmarks, right? You don't really need your option P&L when your underlying goes up that much. Rolling up, I get it. Rolling up and rolling out, again, it probably gets tested here and there, but your P&L is so good on the equity side that you don't really care, but you're hedging it a little bit with the short call, rolling it out, adjusting your delta. So whatever delta it is on your equity side, you're probably hedging it with the short call. I think it's mostly a hedge versus a income strategy here. Because the P&L is coming from the stock side. It's not probably coming from the option side. So it's not an income strategy. I think it's a hedging strategy using short calls on these tickers, especially these tickers. It is income. Okay, you are making income. That's fine. 500K last year. Yeah. So big positions, I'm guessing P&L going up on the equity side, some hedging going on the income side. This is all great stuff. Good stories. I hope to see everyone soon. If there are no more questions, I'm going to get going here. Tax-free from Roth IRA. Okay. Yeah, I haven't really looked into the tax implications of these. I know the short-term and long-term tax percentages and all that, but again, not typically into the Roth IRA or any other kind of accounts. I haven't looked at it yet, but I need to do more research. I do get asked a lot from my audience. They ask me about the tax implications of short-term trading. But ours is short-term, right? It's a 45-day, 30-day trade. It's not long-term. That's a good question. 3 p.m. Pacific. And it will be recorded. Recording is available if you sign up. Join this community on Discord. This is my community on Discord. And we can talk more. I'm active there. I'll see you later.